Hi and welcome to this week's edition of Macro Minutes. I'm your Head of Trading, Mark Gardner. Information summarised in this webinar does not constitute financial or professional advice. It's general in nature and does not take into account your specific circumstances. Okay, stocks in our universe this week. We've got Sydney Airports, Centuria Industrial REIT and National Australia Bank. So Sydney Airport announced a scheme implementation deed with the Sydney Aviation Alliance on the 8th of the 11th. It announced on the 8th that it will acquire 100% of the shares in Sydney Airports by the way of the scheme of arrangement and 100% of units. Under the scheme, Sydney Airports security holders will receive 8.75 cash per staple security. UniSuper Limited will transfer its existing interest of 15% in Sydney Airport or for an equivalent interest in the holding structure of the consortium. The scheme consideration values Sydney Airport at approximately $23.6 billion. The scheme meetings are expected to be held first quarter of 22, with an implementation date of around late February in 2022. On the back of the announcement, the stock opened up almost 3% at $8.46. It's still trading around about these levels. Next up, we've got CIP. On the 8th of November, CIP announced the acquisition of 4 strategic urban infill assets. These have been acquired for a collective value of $130 million, roughly. The assets are all located on the eastern seaboard and have increased the number of assets in CIP's portfolio by about 5.3% and the asset value by approximately 3.7%. These assets are aligned with CIP's acquisition strategy of acquiring properties in land-constrained infill markets where tenants' demand outstrips supply forecasts. The relatively short weighted average lease expiry of the portfolio, 3.5 years, means that CIP will be able to actively manage the portfolio, enabling asset transformation from currently under renting to being able to capture the outsized rental growth in the region. Initial yield of the portfolio is 4%, while the capitalisation rate is 4.22. The occupancy rate is 98, skewed by the 89% occupancy rate of the Queensland-based asset. So I think CIP's general weighted average lease expiry is nearly 10 years. So I'm sure they'll probably bring those in-demand assets in line with the rest of their portfolio. And these generally these lease agreements and things like that are indexed to inflation as well. So with all the talk about inflation at the moment, it's probably not the worst asset in the world, just in case inflation really does take hold and it isn't transitory. Rightio, NAB on the 9th, they reported really strong results with cash earnings of $6.6 billion, beating the expectations by 2.1%. That represents a 76.8% increase on their financial year 20 results. The bank reported a full year dividend of $1.27, also beating expectations by 2.6%. Further, NAB's EPS result of 1.963 beat expectations by 3.3%. This came despite revenue decreasing 2.2% year on year, which was expected because of the decreased net interest margins, 6 basis points decreased to 1.71%. They reported a CET1 ratio of 13%, beating expectations by 2%, while also being 153 basis points above financial year 2020's CET1 ratio. With this ratio well above APRA's CET1 band, this gives NAB further potential for buyback programs or larger dividends. They've had a strong start to 21. They views that the extended Sydney and Melbourne lockdowns, along with other disruptions, have postponed Australia's recovery until 2022. On the day, they started up at record highs and drifted off. The following day, but it made the rest of the banking sector a bit buoyant on a day where there was a weak financials lead from the US. Next day, I think they rallied 3 to 4%. So it is one of our preferred of the big four. Rightio, trading stock of the week. So a little bit different this week. This isn't a new recommendation. This was part of our green hydrogen feature play from September 3rd. Just wanting to give a little bit of an update on this, and essentially because it's not particularly normal in terms of having a single stop loss and single target price. So we do have 2 target prices on this one, mainly because it was a speculative recommendation. So we had 3 in the portfolio on the feature play: Lion Energy, Hazer, and PH2. So Hayes is up about 80% since we got in. Lions up over 200, and these guys, when they got up to 84 the other day, were obviously in the mid 300%. So our first target price there was around about 60. There was a bit of a gap open that day, so most people got better prices, which was great. But this is just an example of, obviously you can see the chart rounding out a little bit there. They've had a couple of great announcements. They're going to build 3 green hydrogen plants on the east coast of Australia, Sydney, Brisbane and Melbourne. So that really pushed the price up. I think they nearly doubled basically in the space of a couple of days. So but this is all on the back of the thematic, which we were sort of looking out for from the Glasgow Climate Change Conference or Summit. Also, this is something that we saw Scott Morrison, the Prime Minister, commit to publicly on a Global Leaders Zoom call, that he wanted Australia to be the green hydrogen valley, similar to Silicon Valley, going forward, because he was under fire a little bit from world leaders for being a little bit slack on climate change action. So that's kind of what pushes towards this thing. So it will be a big election issue. Climate change is by far the largest polling issue leading into the election. There was talk of an election before Christmas, but recent drop in opinion polls for the LNP, we're now looking possibly, they're speculating around about May. So with Glasgow finishing now, or finishing today basically, and there being, the election being pushed out, this thematic might cool a little bit. We may see a little bit of a pullback. It's had quite an extraordinary run. So I think we'd be looking to buy dips potentially again, somewhere around that sort of 50 to 40 mark, potentially, now that the thematic's been proven. It was at the time, it was quite speculative, but it's all the rage now. So we'll have to keep a look out. There's many stocks in this sector. You have to be very careful which colour hydrogen when you're selecting your hydrogen plays, because obviously the blue hydrogen, brown hydrogen, turquoise are all still carbon emitting, whereas green is where they're really trying to push. Fortescue have also made a massive play in this area as well. So certainly an interesting thematic to keep up with, and the trade's progressing really well so far. Okay, stocks to watch out for. We've got Elders, New Farm and Soul Pattinson. So Elders are going to release their results on Monday. Analysts forecasting earnings before tax growth of about 28% to 155 million. NPAT growth of about 31% to 141 million. They stated previously in their financial year 21 outlook that COVID was expected to disrupt global and domestic markets, but significant financial and operational impacts to Elders would not be expected. Elders have previously mitigated these risks through measures of early procurement of inventory, high demand for crop inputs, particularly fertiliser, crop protection, as well as high demand for farmland real estate fueled by favourable commodity prices and low interest rates, and good seasonal conditions should attribute to strong, stronger than expected full year result from Elders. They also run most of the cattle sale yards around, cattle prices at record highs as well, so they're taking a clip out of all that stuff. As a lot of restocking's going on after the drought from a few years ago. Climate models are pointing to another La Nina event. Above average spring and summer rainfall could lead to good soil moisture into the next year. High commodity pricing should result in above average winter crop yields. So those soft commodities have been going really, really well lately, on a futures basis. So all things point to this being quite a favourable report. New Farm, similar thematic. They're going to be releasing their results on the 17th. States that financial year 21 earnings are significantly weighted to the first half, which was strong due to channel restocking and strong early demand. The lowering of the cost base due to performance improvement program is expected to be evident in the financial year 21 results, ultimately increasing earnings. They're expected to benefit from from rising grain prices, increased plantings and robust spending on crop inputs, despite rising input costs and tight global supply. They stated that COVID increased their supply chain and freight logistic costs in the first half of financial year 21. However, the business still remains resilient. Further, the lower demand for omega-3 canola has affected revenues, but the US FDA approval of Nutriterra in dietary supplements is a positive step for the commercialisation of new seeds omega-3 canola. So they are quite high at the moment. We had an investing rec out on them last week. They're really looking quite technically strong, and as we said before, the thematic overall for these agricultural companies should be quite good. So you will need to be mindful of when these announcements come out, because these agricultural companies do tend to move quite significantly on the back of these reports and then remain relatively stable. So you want to be speaking to your advisor or have your orders in there on those on those announcements on Monday and the 17th. Next one we got here is Washington H. Soul Pattinson and Co. Their ex-dividend date's on the 19th. The dividend payment will be made on the 14th of December. The group underlying profit tax rose 93%, attributed to Brickworks' solid performance from both its building products division. New Hope Corp also strongly contributed due to a thermal coal price recovery. They stated that despite ongoing effects of COVID-19, the portfolio continued to perform well, with most investments increasing earnings in financial year 21. They're paying 82% of its net cash flow from investments as dividends to shareholders. A dividend of 36 cents per share was in line with expectations, producing a yield of 1.94. Very, very solid, consistent performer. From what I recall, I don't think they've ever missed a dividend. So they're a not a bad staple overall. Usually trade a little bit of a premium, so you've got to be careful. But they're sort of one of those ones that you want to be buying when perhaps when the market pulls back. Right here, looking ahead, we got RBA minutes, resale sales data. So next Monday, 1 p.m, we got Chinese retail sales. Recent indications of an economic slowdown in the world's largest commodity importer. Retail sales data from China are especially important this month, given they serve as a primary gauge of consumer spending. Also, there's a lot of overkill and speculation about the growth in the slowing in growth in China at the moment. The numbers aren't really painting the same sort of alarmist picture that a lot of analysts are. I think this would be more important for turning around these our materials sector to the upside if it's actually a really good number. I don't think it's going to have a huge effect if it's a negative number, because I think a lot of it's very much priced in. But worth watching as well. People are very cautious around Chinese numbers. Conspiracy theorists sort of thinking the Communist Party might manipulate some of these numbers every now and then to suit their arguments. But to be honest, they've worked out fairly consistent over the years, and that's really just people making excuses for getting things wrong generally from the analysts. So it should be fairly closely watched. Evergrande did make a payment as well, albeit delayed this week. So the dust seems to have cleared there for Evergrande. So we are seeing the materials pick up a little bit in the last week. Fortescue rallied 10% yesterday. I think it's about up 4% so far today, which is a little bit on the back of some green hydrogen stuff. But iron ore prices seem to be bottoming and just a little bit. BHP and Rio were also up. So 3 to 5% each the last 2 days. So yeah, now next Tuesday we'll have RBA meeting minutes. Lagging information. We did have a webinar from the RBA governor straight after the last announcement. We've had massive volatility in bond yields in Australia. Look, it will just confirm, I would imagine, what's already out there. The RBA's kind of already addressed this, which was a little bit unconventional, but given, as I said, massive movements in the bond market and the removal of the targeting of the 3-year part of the curve, they really had to sort of address it, fairly swiftly instead of waiting for this sort of thing. So there may be some small insights as to what they're looking to do in future and in terms of timing. For rate hikes, etc. But the RBA are generally pretty on message, so don't generally expect too many surprises out of these sorts of things. it doesn't happen very often on a percentage basis. Next Wednesday, 12:30 a.m. The States has obviously moved off daylight savings time, and we've moved on now. So these figures used to be at 10:30 p.m. Now they're at 12:30 a.m. They'll be released, same as China, really. Primary gauge of consumer spending. Their core retail sales are released at the same time, which excludes automobile sales, which is about 20% of the retail sales. Used cars obviously has been a huge, sort of price increase, etc. But these numbers will be pretty closely watched. There's been a dramatic drop in COVID numbers over there, and they did have a really solid employment number last week. So these could be quite positive, and actually really give the market something sort of positive to smile about, apart from corporate earnings, which have just finished. So realistically, what you need to be watching out for is any real massive move to the upside in bond yields, both in Australia and the US. And worries about inflation are really the big concerns at the moment. So if inflation turns out to not be transitory and is it ends up being sort of lingering effect, then we're going to see probably those high PE stocks, high debt stocks, which is usually a common trait of the tech sector, really come under a lot of pressure because you're going to be able to get yield and guaranteed government bonds. So CPI came out last week in the US at the highest year-on-year reading since 1990. So we're the hope is from the Fed that we will have basically, it will be transitory on the back of supply chain issues being solved. Some of the shipping ports in LA are starting to sort out some of their issues. They're starting to charge higher prices to pick up during the day to clear the docks. So I think the Fed's sort of fingers crossed that once the supply chain issues are sorted, that prices will start to settle down a little bit. So that is that'll end up being the huge question over the next sort of 6 to 12 months. Thanks for attending, and we will chat again next week.